partner, Rudy Blanchard, as well as our colleague, Andrew Poole, who manages our fixed income investments. The purpose of this conference call is to provide you with an update of what is going on in the markets and share with you our take on it. Since we have quite a few topics to cover, we'll jump right in. There are three main topics that investors have been focusing on, and in order: the ongoing drama in Greece, the bursting of the Chinese stock market bubble, and the Chinese government's aggressive attempts to stabilize their markets, as well as concerns about the timing and the magnitude of any Fed rate hikes here in the U.S. These events have been creating a strong sense of investor unease and uncertainty. We're going to address each one of these for you in order. Let's turn first to the foremost problem that has been weighing on investor sentiment, and that is, without a doubt, the ongoing debt drama in Greece. We have covered the origins and an overview of the crises going over in Greece and concerning a potential Brexit and prior research reports. So we're going to focus today on the updates and what the outlook might be going forward. First of all, after a marathon meeting of the heads of the Eurozone government, the European Council announced that Greece and its creditors had reached a deal on a bailout that's worth about $95 billion. There are a few steps that need to be implemented. Of course, the Greek Parliament is going to have to approve the broad agreement. They're going to have to implement spending cuts. They're going to have to implement tax hikes. And they're going to have to implement pension reforms. After that, national parliaments from several Eurozone countries, including Germany and Finland, which have been taking a really hard line against Greece, are also going to have to ratify the agreement. Then and only then can formal negotiations over a third bailout begin. This process could take weeks. The goal is to make enough progress before July 20th, when Athens had to pay 3.5 billion euros to the European Central Bank. A week is a very long time in the Greek crisis, and there are several things that could derail the process. But at least for now, the clear short-term victors are the global stock markets, as we have seen over the last several days. If, that's a big if, progress continues, the risk of contagion, the risk of collateral damage affecting other countries may have been avoided. A few things we're keeping our eyes on: the Greek government and the Syriza party may potentially fall. The radical left party is in power, and they are very unhappy about the agreement that was reached, and they may potentially revolt, causing new elections to be called and potentially forming a new government. Also, any deal that is struck will probably have to have debt relief by the creditor nations at one point. When you analyze the numbers, when you analyze these statistics, it's very unlikely that, given the magnitude of Greece's debt, given the magnitude of their economic problems, that they'll ever actually be able to repay over an extended period of time the amount of money that they owe. And as a result of this, this Greek drama may have been solved in the short term, but it may continue to drag on with periodic outbursts, perhaps over the next 6 months, perhaps even over the next year. Needless to say, we'll keep a close eye on developments for you. Let's now turn to China and the current bear market in stocks over there. Chinese shares have tumbled much faster and much further than any of their global peers, about 30%. They've suffered the first bear market retreat since 2012, and to give you an idea of the magnitude of the losses, they have erased more value in a month than the annual economic output of the UK or France. Now, the Chinese government has not been sitting aside. it's been stepping in and trying with a variety of measures to prop up their markets. It's a little too early to determine the success. Also, a few strategists have been arguing that China's weaknesses will tip the global economy into recession. And we feel that this perspective is too much of an outlier at this juncture, but needless to say, it bears keeping a close eye on. The other obvious question is, what about the impact of the U.S. markets? We think it will be perhaps somewhat limited, at least at this juncture. A few overseas businesses are listed in China, and this helps reduce the real long-term impact of the decline beyond China's borders. One of the other questions that we've been asked is, after the magnitude of these losses, is it now time to go bargain hunting in Chinese stocks? We think the answer to this question is not just yet. These stocks need to fall potentially a lot further before they're worth buying. And let me give you an idea of what we're talking about. Even after the sell-off, China's Shanghai Composite Index is still 89% higher than it was a year ago. When you take a look at its valuation measures, say how expensive or inexpensive they are, they're still 50% higher than the 5-year average. The median price-to-earnings ratio on Chinese stock markets is the most expensive among the world's 10 largest markets. The other thing to factor in is that 1,300 shares were frozen by trading halts. The prices that we're seeing may not fully reflect a buildup of selling pressure that has not yet been released over the past month. Once these shares are allowed to be sold, we could see another leg down. If we get a significant pullback where the shares start to become attractive again on a valuation basis, these Chinese stocks are definitely on our radar screens to potentially pick up at bargain basic prices. The third source of unease is primarily focused on the Fed rate hikes, although there are other issues. The New York Stock Exchange trading shutdown, there were concerns about a potential cybersecurity breach, which have found not to be the case, but nevertheless it adds to a little bit of the investor angst. Also, the MERS over in South Korea, there's also concerns that the markets have risen so much since 2009, and the U.S. stocks may be fairly valued. Typically, over the course of time, the Fed raising interest rates is at one point a negative, potentially a strong negative for stocks. So the $64,000 question is, when will the Fed raise interest rates, particularly factoring in the developments in Greece and factoring in the developments in China, and by how much? To give you an idea of where many investors are placing their bets, in recent days with the U.S. economic growth coming in uneven, again with Greece, again with China, traders in the interest rates markets have pushed out the date. Now they're expecting the Fed to hold off all the way until January in 2016. However, the Fed may have a different opinion. Federal Reserve Chair Janet Yellen, at a speech she delivered to the City Club of Cleveland, essentially reiterated her now familiar Fed talking points. The economy is improving, employment is dropping, and inflation is getting to healthy levels. It seems that they may potentially be on track to raise them in September. However, there's a great deal of uncertainty associated with this, and if they do raise them in September, I would be surprised if they came with a second interest rate in quick succession. It may be one-off and then stop for a while and see how the economy unfolds, and it would make sense for them to get a safety net or a cushion, so to speak, before setting in motion the second interest rate hike. That means that we could have some increased volatility, but it may not be enough to derail the strong run-up in stocks that we have seen since 2009. And our perspectives on this is that the Fed may follow the advice of the IMF and other bodies and delay any interest rate increases until 2016. That will be a bullish development for U.S. stocks. However, some of the recent statements by Janet Yellen seem to indicate that that may not be the case. There's essentially a great deal of uncertainty associated with the magnitude and timing of any Fed rate increases, which will increase, unfortunately, both the volatility and investor uncertainty regarding the stock market. At one point, Chinese and even Greek stocks may be an attractive buy. However, we need to see more progress in the sell-off and more attractive valuations present themselves in China. And in Greece, there's so much political uncertainty, which is very difficult to create a logical game plan that we would like to see increased clarity and a more solid resolution, particularly including long-term debt relief before wading into those waters. And also, the recent pullback is, from a long-term perspective, is nothing more than a tempest in a teapot. A correction would certainly do after the strong rise in world markets that we've experienced from 2009. And our current prognosis is that the stock markets should continue to increase, albeit at a more subdued but positive rate of change and with more increased volatility. And with that, I will now turn it over to Rudy. Rudy.
Thanks, Eric.
This is Eric Greshner, Managing Partner at Regatta Research and Money Management.
Okay, we're clear there?
Sounds like it.
Okay, so what we ask our clients and listeners out there to pay attention to, and certainly what we want to do, is to avoid some common mistakes. And mistake number one is always expecting a smooth ride. With the dynamics that are involved in today's market, much more so than, say, 20 years ago, there's a lot more pieces to the puzzle. And what we found was that in the last 35 years, there's been an average decline in the market of 14.2% in any given year. And despite that, the market has returned positive numbers in 27 of the 35 years. So again, we can't expect a smooth ride. We should expect volatility, at least for the short to intermediate term. It's just part of the process, and we ask our clients not to panic when we see bad news coming down the pipe. And of course, mistake number two is trying to time the market. Few stories will show that methodology works. In fact, most of the time it does not work. When you do try to time the market, you will eventually miss out on any upswings that the market presents, which in some years are few and far between. Mistake number three, making emotional investment decisions, which falls under the category or the classical field of study known as behavioral finance. That is, changing your risk profile based on short-term market developments, selling based on fear, or buying when you think that the market's undervalued. Leave all of that up to us, if you will. We will make those emotional decisions for you. Mistake number four, spend too much time listening to financial news media. Any of you guys tune into Facebook or Twitter or whatever the case may be, there's bad news out there that I can count. And it's very hard to decipher what is actually accurate, but in that sense, we find most of it to be inaccurate. And particularly when people try to predict what's going to happen in the market. And as Warren Buffett once said, I have trouble predicting what one stock's going to do, much less the whole market. Then, of course, mistake number five is focusing on the short term. Any of your goals or any of your financial situation issues have changed, please notify us, and then we can amend that long-term goal for you. So that would involve another conversation, of course, but also if any of your financial situation components change for whatever reason, please let us know. We'll address that accordingly. So now we're going to open it up to questions. Andy Poole's going to join me on this. So do we have any questions about the content that was discussed?
Yeah, Rudy, I have one. This is Nyla Gudekunst. And
Hello, Nyla.
hi. My question is, and this is the question of a novice, a federal rate hike, is that an increased tax on investment? Like, what is a federal rate hike?
Yeah, federal rate hike is basically the Fed increasing the cost of doing business across the board.
Okay.
So they use that as a tool to slow down the economy in anticipation of perhaps inflation. So right now, let me give you a 5-minute synopsis on what we see. The United States economy as a whole is doing fairly well, particularly in relation to other countries. What we found is that unemployment is now at a respectable level of about 5.3%. We're finding less unemployment claims on a weekly basis. Furthermore, consumer confidence is above the average level. And what we mean by consumer confidence is that are consumers spending money? And why is that important? Well, consumers make up 3/4 of our economy by buying goods and services, right? And what we find is that light vehicle sales, pickup trucks, cars, what have you, are basically at an all-time high. So if you're a consumer and you want to buy that vehicle, you have to be feeling pretty good with the prospects going out 5 or 6 years. Home sales, record highs. So those long-term commitments by consumers would suggest that consumers are feeling pretty good about the economy, hence an increase in spending. And with that, Janet Yellen, in her rhetoric last Friday, suggested that they would eventually raise the federal interest rate or the Fed rate sometime late this year. In retrospect, when you go back, Nyla, and you look back 5 or 6 years, we have a very accommodative borrowing policy. Rates are, below 3% on home mortgages. Your credit card rates are low. So what the Fed does in an effort to prevent inflation from rearing its ugly head, they will raise rates via the federal interest rate to slow down the economy to make sure it's evenly balanced. If they don't do that and inflation comes, then we have bigger problems than had they not. So I hope that kind of answers your question, but it's a mechanism that they use to control the balance of flow of funds in the economy.
Okay.
And Nyla, this is Andy.
Hi.
Ultimately, you do want some level of inflation. A number of papers have been written, like, is it 1 to 3%? Because a growing economy will create that, and a rate around 1 to 3% would be good, a federal funds rate. And we're well below 1. So a rate hike is not only expected, but it is necessary. And the Fed only has 3 opportunities for the rest of the year to do it, which is September, October, and December.
Uh-huh.
And I'm actually hoping for a rate hike in September because it shows that the country as a whole is on the right track. We need to get out of this 0 to 0.25% federal funds rate that we've been in for 3 years, and it makes it very tough for retirees and the whole fixed income market to make any money on their income producing assets.
So then the uneasiness about it is just because, it sounds like, when we hear Fed rate hike, that sounds like a bad thing.
Let me throw this at you. Last time the Fed raised rates was 2004.
Yeah.
The market proceeded to gain 40 months thereafter.
Okay.
So it's not a bad thing, and we're at all-time low in terms of rates. So we're not even in, when they're talking about raising rates, and it's a great question that you present because you're right. The consumer is going to think it's a really bad thing, but the effort here is to get rates back, as Andy had mentioned, in a normal range.
Okay.
Right now they're at a super low range. Right now they're just trying to get them in a normal range, historically speaking.
Okay, thanks. That's clear.
Thank you, Nyla.
Thank you, Nyla.
Rudy, this is Pete Miller. How would you respond would you respond to the comment that unless the Fed really raises rates in September, they won't do it until after the 2016 elections? The Fed's become pretty political as well, and not as independent as they once used to be. And my concern is if they don't raise in September, and I'd like to see a raise myself. I think it's healthy. It's going to be after in my estimation, after the election. How do you guys feel about that?
I think a lot of that's based on how the European economy responds, Pete, and I think because they're a little bit behind in terms of trying to reinflate the economy. The thing to keep in mind is that when you look at S&P 500 companies, for example, those 500 companies generate approximately half their revenues overseas.
Right.
So it makes sense that the Janet Yellen and the Fed committee there would be waiting to see how the quantitative easing, if you will, in Europe responds over the course of time. So they have to make sure that that economy is also getting back on track before they make that necessary rate hike. But after the election, I couldn't have a comment on that. I think it's more based on overseas markets and how they respond to quantitative easing.
So you don't feel our political environment will impact the Fed's decision? They'll look at the world economy as opposed to our politicians.
I would think so, because again, everything's so much more intertwined than it was 20 years ago. And those companies making money, especially multinational companies, whose revenues and profits are based to a large degree on overseas markets, is really going to be the driving point behind that decision.
Okay, well, I hope you're right.
Andy, do you have any comment on that?
I hope he's right too, Pete. I think it would have minimal impact. I mean, I think the fight of it always will be some, but the weight of politics not being involved is heavier now than I think it was 20, 30 years ago, just because the velocity of money is what creates inflation. There's a formula that's used in economics called MV equals PQ. That's monetary base times velocity equals price times quantity. And what happened in the Great Recession is people quit spending, so velocity dropped way down. Therefore, to keep from deflation happening, the Fed issued a lot of money, keeping the monetary base high. If inflation were to go through the roof, whether politics involved or not, even if it was heavily involved, I think the Fed would raise rates. I would personally, though, like to see it in September, like you had said. I'd rather see it sooner rather than later. And in the fixed income market, the managers and the powers that be don't look at the next rate. They're looking at the rate after the next rate. So right now, when I'm looking at fixed income in the market, the next rate might happen in September or December or maybe October, is already priced in. Their concern, or the fixed income manager's concern, is what's the next rate. And I think that's why we're going to see a sort of bottom. The high yield market's fallen a lot this year, and we're starting to see a bottom develop. So even if they raise in September, I don't think we'll have another raise anytime in 2016 until after the election. So it's kind of, I know that answer is kind of a roundabout.
No, I can buy that. I mean, I can buy that philosophy because it's just going to be too political, I think, to do that. And if we don't raise rates, it's a signal that the economy is not going to continue to develop, and that's what scares me.
And that's exactly right. By not raising, I think it just shows a sign that, oh, well, maybe this country's not strong enough. The economy can handle it. And Rudy and I are in full agreement. We think it can. Whether you're shipping by railroad, flight, housing, whatever it is, the economy, whatever sector of the economy you're looking at, most of them are doing very well.
Yeah. Thank you.
Oh, you're welcome.
Thank you, Pete.
Any more questions?
I do have another question. What do you guys think in terms of the parallel of our country to what's happening in Greece in terms of, their debt and our debt?
Mm-hmm. Mm-hmm. Yeah. I'm sorry. Go ahead. Did you finish? I'm sorry.
No. Yeah, I'm finished.
Yeah. Well, you've got I guess the parallels are that, we both have a lot of debt. I think the United States is 1-to-1 right now, which is debt to GDP, maybe a little bit north of that. In Greece, it's 2-to-1. And the issue there is that because of the radical left-wing party that's in control right now, they're against any of the austerity programs that are being proposed. So, that situation it could get very volatile before, it gets settled, because what they're proposing, of course, is wage cuts, pension reform, tax hikes to the ordinary citizen. A lot of corruption in Greece, a lot of tax evasion has transpired over the years. So this is the third or fourth relief program that's been offered to Greece. So the question then begs is, what are the chances of success? Just from my perspective, I'm a comment that it's not very good. Now again, you have a 2-to-1 debt to GDP ratio, and again, it's an alarm for the rest of the world, because once the debt starts climbing through the ceiling like it has been, particularly in the last decade or so, we've got concerns. But it's not at a dangerous level in terms of what's happening in Greece. And on top of that, Greece's output, or its contribution to the global economy, is probably less than 2% of GDP. So they're a small player in terms of what they produce, but as a precedent for what could happen, it's real.
Yeah.
And that is, once your debt's out of control, then the citizens suffer. And that's basically what we're seeing. Did that answer your question, Nala? I'm sorry.
Yes, it did. Thank you, Rudy.
Mm-hmm.
Yeah, it's kind of grim.
Yes. Okay. If we don't have any more questions, or if some questions do arise after we discontinue the call, please send us an email or drop us a call at 831-4636, and we'll be more than happy to answer any questions that you have.
Quick question for you.
Uh-huh.
Yeah, this is Chuck Hobson. What's your long-range thinking on Hillary Clinton, Democratic presidency versus a Republican?
Woo! Man, I'm opening that one up for everybody, because...
yeah, and you know what, Rude? I'm letting you take this.
I don't know. I mean, we certainly have enough Republican candidates out there, don't we? I've read studies, Chuck, that or saw some comments that, and again, political parties aside, or preference aside, that it seems to me, and what I'm seeing is that, and I don't understand it, but the majority of voters out there do want another Democratic president in there. So I don't know if that's going to happen. But you can rest assured there's going to be a lot of personal attacks either way. And I also read something that this next election could be the dirtiest of all elections, just because of what
Clintons are involved.
Yeah,
I'm sorry?
Especially if Donald's involved.
Yeah, exactly. He's not holding back. So. Yeah, who knows, man? That's a question that I wouldn't even attempt to answer. But just based on what I'm seeing, it's very confusing at this point.
Okay.
But I think for our purposes, in relation to the question that Nyla just presented to ourselves, we need someone who's going to be a little bit more conservative in how we're managing the affairs of the country. And I'll leave it at that.
Thanks, Rudy and Andrew. We got to sign off here, but we really appreciate you guys doing this.
You're
Anytime.
welcome. And actually, Libby
I have
brought
a
up a
question
point.
regarding the Greek economy. IMF is advocating a debt relief program before they participate, and also the German finance minister, I think yesterday, was also advocating Greek.
Hello?
Hello? Hello?
I lost connection.
Hello?
I'm still
Hello?
here. I'm still here.
Can you hear my
I'm not
question?
sure if people can hear me.
Yeah, you're breaking up, but I can still hear you.
Yeah, my question was about the Greece economy, and IMF came out yesterday publicly stating that they want a strong debt relief program incorporated before they participate.
We must have lost him. I can't hear anybody on my end.
Hello?
Hi,
We're
can you
having
hear
a little
me?
bit of technical difficulty. If you want to go ahead with your question.
Hello.
Yeah, my question is actually, I typed my question in.
I'm sorry, your question was what?
I typed my question in if you are having difficulty hearing me.
Okay,
Okay.
I was able to reconnect. Andy, were you able to catch it?
Yeah, well, actually, he typed it in, and I have it here. So this is what the question is. The IMF just came out publicly stating that a debt relief is almost necessary before they participate. Also, German finance minister is advocating Brexit. What is our view on this? And I can put in a little bit on this. Vining Sparks is one of the bond houses we do business with, and they put out a notification today that the structure or the deal that was set with Greece, IMF is not happy about because there's no debt restructuring.
Mm-hmm.
And now the IMF is wanting to kind of go to bat on Germany's side. But that's as far as I've got on...
Yeah, I think the Parliament's meeting, and they have 48 hours to come up with some solutions in terms of, how they're going to restructure this, which is a short amount of time. And I guess what the German Chancellor is thinking is that it's probably not going to happen, or it's not going to be a solution on the table. So it's almost in the realm of 3 strikes you're out. I mean, it's happened 2 or 3 times before in Greece, and they haven't come up with any remedies to take care of this. So that would, my opinion would be, yeah, I don't think it's a good proposition at all. But and again, the citizens are going to suffer for it. But I do believe that the clock is ticking on the Parliament as we speak to come up with some type of solution in restructuring the debt. Andy?
Yep, I'm here.
Okay.
No, I think that's as far as, the whole deal hasn't been investigated, and they still have time to do it, so it's still kind of up in the air.
The Greeks don't have any will to change their problems. I mean, and with their economy, there's no way out of this thing unless they get debt forgiveness. And once that starts to go, then you're going to see 3 or 4 more countries that are going to do the same thing. So,
and that's why they have this keep popping up.
Fear, I think.
Yeah, the change that's necessary involves political connections who don't want the change, right? And that was kind of part of the problem as to why they got in this financial mess in the first place. So unless the infrastructure changes within government, then nothing's going to get solved. That's my take on it. And
listen, they all try. I mean, they have a way to camouflage the swimming pools over there so they don't have to pay the tax on the pools. I mean, the Greek people are not willing to do what needs to be done. Forget
exactly.
the political environment. You've got no will on the people.
Well, the Greek people are the ones that are going to suffer.
Yeah.
So they're the ones. They're asking the Greek people to take wage cuts, to have their pensions reformed, and to agree to tax hikes across the board. So, good luck.
Yeah, I agree.
Okay, any more questions?
Listen, thank you, guys. This is a wonderful deal. I'm pleased that you did this. And, you guys just keep up the great work. This is Pete Miller. Thank you.
Pete, thank you for the feedback, and stay tuned. We'll have more coming down the pipe, okay?
Wonderful.
Thank you.
Bye-bye.
Thank you, everyone. Have a great day.
All right. Thank you.
Bye.